Good morning and welcome to TOITOI Japan Market Radio for December 17, 2025. I'm your host coming to you from Tokyo with a briefing designed for global investors tracking Japan's equity, currency, and rates markets. Let's dive straight into today's session with our portfolio manager. What's the picture looking like across Japanese assets this Tuesday?
Thanks for having me. We're seeing a mixed picture in Japan today with some interesting divergences worth unpacking. The Nikkei 225 closed at 49,512.281, up 0.261%, so a modest gain there. TOPIX was essentially flat, down just 0.028% at 3,537. The Mothers Index, which tracks smaller growth names, fell 1.019% to 2040. Showing some weakness in that segment. On the currency side, dollar-yen is trading at 155.542, up 0.34%, so we're seeing continued yen softness. J-Rights edged up 0.025% to 2025.0, while commodities showed strength with gold in yen terms up 1.388% to 16,065 and crude oil rising 1.52% to 56.11.
So the headline indices are relatively calm, but there's clearly more happening beneath the surface. Let's turn to the news flow because there's quite a bit for global Japan investors to digest today. We're seeing headlines about U.S. inflation concerns creeping back into the narrative, which is being described as the inflation Grinch showing up on Wall Street. How should Japan-focused investors be thinking about this resurgence of inflation worries out of the U.S.?
This is really important for anyone with Japan exposure. What we're seeing is a shift in the U.S. inflation narrative where market participants had perhaps gotten too comfortable with the idea of smooth disinflation, and now there are renewed upside risks to inflation emerging. For Japan specifically, this matters on several fronts. First, higher U.S. inflation typically means the Federal Reserve will need to keep rates elevated for longer, which supports a stronger dollar. That wider interest rate differential between the US and Japan becomes more pronounced, and we've already seen that reflected in dollar-yen pushing above 155 today. Second, a stronger dollar affects Japanese export competitiveness, which is crucial given how export-dependent the economy remains. Third, elevated US rates can also mean higher input costs for Japanese manufacturers importing commodities priced in dollars.
And this presumably has implications for the Bank of Japan's policy path as well. If the Fed stays higher for longer, does that complicate the BOJ's normalization timeline?
Absolutely. The BOJ has been moving very cautiously toward policy normalization, but if US rates remain structurally higher due to persistent inflation, it creates a challenging dynamic. The BOJ would face pressure to eventually follow with further rate adjustments to prevent excessive yen weakness, but they're also constrained by domestic growth concerns and the fiscal debt burden. In terms of market impact, for Japanese equities we'd expect near-term pressure, particularly on cyclical exporters whose earnings outlooks become less attractive in a higher rate, stronger dollar environment. However, there's a silver lining for domestic-focused stocks and financials, which could benefit if the BOJ is eventually forced to accelerate normalization. On the yen, the outlook is clearly for further weakness as the carry trade dynamics become more attractive with that widening differential. And for JGB yields, we could see modest upward pressure if the BOJ faces policy pressure, though structural factors still limit how far 10-year yields can rise in the near term.
Staying with the equity theme, there was actually a contradictory headline today about the Nikkei dropping 1.56% amid bearish sentiment, yet at the same time we saw this extraordinary 29.07% surge in S-Science. That seems like a really stark divergence. What's going on there?
Yes, that's a really interesting divergence that speaks to the current market environment. The 1.56% decline in the Nikkei reflects broader bearish sentiment and suggests we're seeing some consolidation or profit-taking after recent gains. This could be driven by the macro concerns we just discussed, global headwinds, or simply positioning ahead of year-end. But then you have S-Science, which is likely a biotech or life sciences name, absolutely soaring nearly 30% in a single session. That tells you there's significant company-specific news or sector-specific developments driving that move. What this divergence really highlights is the selectivity in the Japanese market right now. Traditional large-cap exposure, the blue chips that dominate the Nikkei, are facing pressure and investors are being more cautious there. But innovation-focused equities, particularly in growth sectors like biotech, are still attracting very strong investor interest. We're seeing performance dispersion widen across market segments, which is why that Mother's Index decline of just over 1% is also telling. It shows smaller cap growth as a whole is under some pressure, but individual stories can still outperform dramatically.
So for portfolio managers with Japan exposure, this suggests you really can't just hold the index and call it a day. Stock selection matters more in this environment.
Exactly right. In terms of broader market implications, when you see the Nikkei down 1% or more, that typically supports yen strength because investors reduce risk exposure and repatriate capital. However, we need to look at the broader global context to confirm whether we're seeing actual carried trade unwinds or safe haven flows. Given that dollar-yen actually rose today, it suggests the US inflation narrative and rate differential story is the dominant force, overriding any risk-off yen strength. For JGBs, a risk-off environment would normally support bond prices and compress yields, but again the BOJ's policy stance remains the primary driver, and we haven't seen dramatic moves there.
Meanwhile, there was also reporting on broader Asian equity markets today, noting that the Nikkei actually rose alongside other regional benchmarks like the Hang Seng, Shanghai Composite, and Kospi, with tech sector strength being a key driver. That seems to contradict the bearish tone we just discussed. How do we square these different narratives?
Good catch, and this is where intraday volatility and different timestamps on news flow can create apparent contradictions. What we likely saw was weakness earlier in the session followed by a tech-driven rebound that pulled the Nikkei and other Asian indices higher by the close. The tech sector strength is significant for Japan because Japanese technology and semiconductor holdings, names like Sony, Tokyo Electron, and Advantest, benefit enormously from broad-based tech momentum across Asia. This suggests improving sentiment in a sector that's critical to Japanese export growth. The synchronized rebound across regional markets, the Nikkei moving in tandem with Hong Kong, Shanghai, and Seoul, indicates we're seeing coordinated recovery in Asia that reduces Japan's relative isolation. That's supportive for cyclical demand facing Japanese manufacturers.
And the risk-on environment implied by tech strength, what does that mean for currency and rates?
In a risk-on environment where investors are rotating back into growth and higher beta assets rather than defensive positioning, that's typically supportive for Japanese equities, particularly export-oriented and semiconductor-related names. We should see upside momentum in those segments. For the yen, risk-on sentiment usually encourages capital outflows from safe haven currencies, so you'd expect modest yen weakness. However, any depreciation may be limited without broader macro catalysts beyond just intraday risk appetite shifts. On JGB yields, if equity strength reflects genuine cyclical recovery expectations rather than just technical trading, you could see modest upward pressure on yields. That said, we're in late December, so positioning factors and lower liquidity can limit significant moves in rates markets.
Shifting back to the macro picture, it sounds like the dominant theme for Japan investors right now is really this US inflation and interest rate differential story. If the Fed does indeed stay higher for longer, and the BOJ remains constrained in its normalization pace, where does that leave positioning recommendations for global investors with Japan exposure?
The rate differential story is definitely the key macro driver right now. For positioning, I'd say investors need to be selective and think about which parts of the Japanese market benefit versus suffer in this environment. Exporters with heavy dollar revenue exposure face earnings headwinds from yen weakness, even though nominally a weak yen should help them, because input costs and competitive dynamics matter too. Financials, particularly banks, could benefit if the BOJ is eventually forced to move more aggressively on rates, so that's a sector to watch. Domestic consumption plays could also be interesting if wage growth continues, though that's a longer-term structural story. And as we discussed, innovation and growth sectors, particularly tech and life sciences, are showing they can outperform regardless of the macro backdrop if the underlying company or sector story is strong. On the currency side, anyone with yen exposure needs to be prepared for continued weakness in the near term, and consider whether hedging strategies make sense depending on your base currency and time horizon.
And on the JGB side, for fixed income investors?
JGBs remain range-bound with the BOJ still very much in control of the curve, even as they normalize. I wouldn't expect dramatic moves in 10-year yields in the near term, but there's definitely more two-way risk than we've seen in years. If you're holding JGBs as part of a global fixed income allocation, the key risk is that normalization accelerates faster than currently priced, which would mean capital losses. But yields are still low by global standards, so the carry isn't particularly attractive either. It's a challenging environment for Japanese fixed income.
Let's wrap up with the key takeaways for our global investor audience today. We've covered quite a bit of ground. What should people be focused on as we head toward year-end?